Hey, it's John with Project Barndo again, and I have a special guest with us today, Megan Yandell from XL Mortgage. And Megan's here to share with me her insight with 20 years of mortgage lending experience, specializing in Barndominium financing. And we're going to talk about low down payment mortgages, specifically your 5% down conventional that seems everybody says you cannot get, but which is not true. You can get 5% down conventional mortgages. And we'll even have Megan give us a little bit of insight on how you can do zero down if you're a qualified veteran through the VA program. So Megan, welcome we're happy to have you be with us today.
Thank you so much. I'm excited to spread some great information and follow in your footsteps. You're really helping a lot of people on a wide variety of topics. So I'm thrilled to be here today.
Oh, great. Well, hey, listen, to that point of trying to help people, and we were just talking a little bit before we got into the program about, a lot of people are saying, custom home, you have to call it a custom home. Give me your insight on this, because you know how I feel about it.
I'll tell you, this is a daily topic that comes up that either I'm asked or I hear about people talking about this. It's a big no-no. It really is. You always want to be factual and honest and truthful with any kind of financing contact that you have or any bank. If it is assumed that it is just a custom home that everybody tells you, don't call it the Barndo, don't call it the Barndominium, don't use the B word, that can go sideways very far into the transaction if they're not aware of it being a Barndominium. So best rule, always call it what it actually is. I literally work with multiple lenders that celebrate the fact that it is truly a Barndo. And then you have absolutely no reason to, minimize that or kind of lower your voice when you say the B word.
Yeah, absolutely. And it's funny too, because I tell people, they're like, hey, if you think you're going to get past, a loan officer, a processor, a underwriter, an appraiser, all these people whose paid jobs are to inspect, plans, specs, and prints, review building contracts, have their properties appraised by two comparables. If you're going to get all those people, that somebody's not doing their job, or they're being incompetent, one or the other. So you actually want a lender that's paying attention to know those things. So I totally agree.
100% true. Yeah. And I think everyone offers that advice to try to be helpful. It's an amazingly tight-knit Barndominium community out there. And bless these people that are trying to share their experiences. However, more often than not, they are not mortgage brokers. They are not loan originators. They're not fully invested, such as you or I might be, that we see this day in and day out. And we strongly recommend, please just call it what it is. And then you're safe across the board.
Yeah, absolutely. Hey, so on conventional, just explain real quickly, if you can, like 5% down. What does that look like for people when, where does 5% come from? How does that look? What does it look like?
Yeah, so the great option, the most commonplace type of loan that we do as far as the one-time close construction loan is the conventional option. It does go up to 95% loan to value, which means it translates into 5% down. If people already own their property, that actually they're coming into the process with an equity position if they've owned it for more than a year. So that might even diminish that 5% down requirement because the land has a value component. If they are wanting to purchase the land outright, they don't have any involvement in it at all. They're not, they're only under contract, but they have not closed on the land. Then that 5% down would come into play. And people would need some type of reserve, bank statements to show that amount, investment accounts, long-term investments, something that is liquid that you could tap into that to get that liquid asset, that cash to bring to closing and accommodate that 5% down payment.
Okay, so let's just do a review for people that are listening and paying attention to the YouTube channels. So if you got $50,000 for a piece of property, let's say $350 for a build, or a total of $400, 5% down on $400 because you're combining the two together. That's going to be 20% down.
Correct. That's going to be $20,000 for closing.
I'm sorry, $20,000, 5% down. Yeah.
Correct. Yes.
Okay. Perfect.
Yep. And so it's that math across the board. And if you want to be conservative, leave a little bit of a cushion there. Just for you never want to have just exactly 20,000 if that was your financials. You would want to leave a little bit of breathing room. The lender is not looking to deplete all of your reserves. They just want to know that you have financial foundation under you to accommodate what's coming up. You will have to go to closing. You will have to finalize that transaction, and they don't want to deplete you down to zero. So keep that in mind.
Yeah. Yep. And now they will have their closing costs. So we've got bank and lender fees, that go on top of that, right? So I know
Correct.
we do. I'm assuming you've got closing. So on top of, for example, that $20,000 to meet your 5%, you're going to have those on top of it. And then reserves, like when you say reserves, what is that? Is that like a month, 2 months worth of a payment type of thing, just sitting in a 401k or something?
It's really comfortable and sometimes very challenging for people to have, 6 months worth of reserves.
Okay.
If that is the case and someone's able to achieve that, that's phenomenal. And that's kind of overkill, but that leaves a huge cushion where lenders are like, oh, this is great. This person leaves that money alone. It's typically seasoned for at least a 3-month period. And when I say seasoned, it means that it's been sitting around for a while. If you think about like a really good barbecue, that meat has been marinating for a while. It's not just, putting it in there for 5 minutes. If it's seasoned money for about 3 months or so, that's what the lender wants to see, that you are not tapping into those funds. You're fine to pay all of your bills and still keep all of that extra money in the bank.
Okay, perfect. Yep, that helps. I think that'll help clarify a lot. What about VA? So what does VA do for qualified veterans? Where can they be at with a down payment?
Our veterans are so special and so important to us and the history of our company. Veterans benefit by having 100% loan to value, which is unheard of in the regular civilian world. We don't get those kind of benefits because we have not paid the dues that these veterans have. So 100% coverage as far as financing means no down payment. If the land and the project that's pending appraises for what the value is, it can actually cover all of the costs, including closing costs. So that veteran has no obligation to come to closing with a dime. So that is a huge benefit to them, and hopefully, something that can be celebrated on any VA loan.
Cool. So, it used to be we'd hear doing a VA construction loan was just a nightmare. Away from a lot of lenders, like even not myself, we don't do them. A lot of lenders don't do it. So, but in today's world, VA lending for construction has been streamlined, from what I understand, quite a bit.
It has, yeah. And I think as time goes on, barndos are, some lenders, it's still a B word, it's still a bad word, but I think more and more guidelines are being alleviated quite a bit, and that includes VA options. There are plenty of options out there for VA clients to take advantage of those benefits and still build a brand new home. It doesn't just have to be a barndominium. I mean, that's my passion. I love barndos, but it could be a typical home, or it could be, a block home, like more typical in Florida. It could be even a manufactured home if they wanted to. So there are a wide range of options out there, and VA is definitely an option. Builders might just have to be assigned a VA identification number, but the builders they don't have to go through an approval process with a VA. It's simply an identifier, almost like a social security number, to identify that builder. So when it does get specified that they are the ones who are going to be responsible for the build, they have that designation.
Okay. All right. That's great. Hey, I don't want to bore people and get into the whole lender banker jargon, right? Because I know that makes people's eyes spin, but I do want to talk a little bit, just real briefly, on what it takes for people to qualify. There's like, hey, I want to do 5% down, but what's it going to take? But before I ask that question,
yes,
you mentioned Barndo's your passion, and I think that's the part I love the best about our community is like it feels like once you connect inside this community, it's like you're meeting friends from all across the country. So
true.
That I built my Barndo in 2018. My son is just finishing on his right now. He's just a couple weeks from being in.
Nice.
I love the whole thing, right? But you just closed on your land, and you are in the process of designing your own barndo, right? And you and your husband built one for your business. You built a barndo for your business. So I feel like when people come to us as lenders and trying to help them the process, that is like a huge element of it, right? Like we've lived through the elements.
Literally.
What are you experiencing right now on your design? Tell us just for real quick on your design. What are you experiencing?
Yeah, and I know you can't tell because this crazy video background here, but I'm sitting inside a 12,000 square foot barndo. This is a commercial application, but this was our first project ever that my husband and I did together for his business. It's an automotive repair facility. He's a Porsche mechanic of all things, so the cute little sports cars. We wanted a barndo that was wide open concept, so we designed it, and this project was completed in less than 3 months. We've been here for going on 8 years
Wow.
now. Phenomenal. So
Wow.
this is kind of my
Wow.
office during the day if I'm not working at home. We loved our experience here so much, and we still get compliments from our clients that come by that we're like, we have to do this. We have to build one of these that we want to live in, not just work in, but live in. And so we have some property in Tennessee, of all places. And I'm licensed in 5 states right now, but Tennessee is pending. That's my 6th state, soon to be. And we want to live there. We want to retire there. So we are going through just some schematic concepts right now to work with the topography of the land. It's off of the lake, but it's not lakefront property, but it has a beautiful view of the lake in Tennessee. And we're just working with, different levels and, expanding it out so we can really celebrate all of the beauty of that. It's kind of half grass and half wooded. And so it's really wide open. It's a little bit challenging. I mean, I have to admit, I went to school for architecture, but now that it's our project, our personal project, it's a lot of, black and white where you have to, decide one thing or the other. And there's not a lot of gray. And once you go with that one decision, then it's kind of a domino effect on some other things. So it's a little bit harder than you might expect, but it's really fun and really exhilarating. And I think the coolest thing about all of this is you can be as particular as you want. You can make that house absolutely perfect for your specifications and parameters.
Oh, that is awesome. And thank you for sharing, because I think that's the big connection, right? Like you can understand what people are going through, the excitement and some of the
trepidation.
Boy, the little bit of anxieties, frustrations that go along with it. So, hey, real quickly, we don't want to bore people with this part. Just real quick. So, just credit score. How much of their income versus gross income, or how much of their income versus gross debt, for a payment. What are kind of the thresholds that people should focus on if they're for you, that if they're doing 5% down, what would be some good targets?
Yeah, so some good targets to aim for. And sometimes lenders are able to think through things, but sometimes it's pass or fail. So with credit scores, we're looking at 700 plus. Okay. So please try to work with that. And just a caveat, a lot of the things online like Credit Karma, myfico.com,
right, good point.
Not true FICO scores. So don't get mad at me when you send me your screenshot showing me that you have a 742 score. And when we pull credit, it's lower than that. That's very, very typical. And it's unfortunately, it's a very big challenge for clients because they think that they're there. But when we actually pull the true FICO, what mortgage lenders require us to utilize, oftentimes it's lower than what those numbers are. So 700 plus. We also would want to see some reserves in the bank. We touched on that a little bit earlier. As far as VA lending with 100%, that actually goes down to a 660 credit score. So a little bit more accommodation there, which is fantastic. And then FHA options are available. Some lenders have those plans put on hold just because interest rates are still a little bit, volatile. They're still ping-ponging around a little bit, going up and down. If we do see a couple more improvements in rate, I know that FHA program will come back like a vengeance, and that'll be another great option that was readily available probably about three years ago, maybe 3.5 years ago now.
Okay. And then for income, just roughly, should people be focusing maybe for their payment and monthly debt, everything like a third of their, gross monthly income, 40%, 45, 20?
Yeah.
What's kind of a rough number that you recommend or see?
30% is delicious. 28% is absolutely glorious. That is very hard to come by, especially these days when people are still a little bit strapped, COVID results with, all these things that are still lingering with people trying to get back on track after they've, had to hit their credit more heavily than typical. But if we can stay around the 40 to 45% debt to income ratio, 45 cents of every dollar being spent on debt, and that includes, housing debt, student loans, credit cards, everything compiled together, that is still doable. But if we can aim towards the lower 40s, if not, into the 30s, that would be phenomenal. The veteran option is quite a bit higher, but we have some residual income calculations that we need to do. So one thing that always seems to be a consistent concern is people just want to know, what's the interest rate? What's the interest rate? And it's not, you don't just go to Home Depot and buy that light bulb. There are so many factors that come into analyzing loan amount, loan to value, the debt to income ratio, all of these other things that get into really specific financial speak, and I don't want people's eyes glazing over,
Right.
but it's not just an immediate answer. Here's what the rates are today. So
yeah. Yep. Yeah, I agree with that. So like, you can give them a range, like here it's kind of some highs and lows that we see, but let's dive in, and then that way we can be specific. So
yes.
Hey, Megan, I appreciate you so much sharing all this great information. I know folks are going to be, I'm sure, in love with the idea that they can actually do 5% down on Barndominiums.
Yes.
But you and I did talk briefly about, some like the critical factor of 5% down, right? Because there's some important information you need to know. Here is the I think this is the critical piece. If you're putting 5% down and you've got your reserves, you paid out some bank closing fees, there's not a lot of room left. So what happens when you go to change something on your project, or you and your builder aren't communicating?
Oh,
Take it over from there, just like we discussed, right?
Yeah, so you are golden as long as everything is the way that you turned it into the lender. If it's on the contract initially and that's what you stick with, everything's fine. But what happens is people start walking around, or they see something else that they like and they're like, oh, can we do that too? Oh, well, now that I'm thinking about it, maybe we should put in that swimming pool that we said that we didn't really want. Or, hey, now we really want to do some amazing hardscape in the backyard with, a fire pit and an outdoor barbecue. Can we do that now too? It looks like we might have a bonus coming in. All of that is fine and dandy. However, the lender has approved the financing based on what was submitted before closing, and what was signed and agreed to at closing. That's what the lender is going to cover. So if we start having change orders where we're literally changing the order that we submitted originally, that's going to be on that client to pay for that out of pocket. And sometimes the client doesn't have that much, in their bank. They might have just blown through a whole bunch of that with the down payment, with the closing costs and things like that were, just a mandatory part of the process. So just beware. Things can be included. If you want a fence in the property, it doesn't have to just be about the actual barndo or the home that you're building. It could be, fencing in the property, doing an elaborate landscaping, along the curvy driveway up to the home. You can include that. And as long as that's in the contract, you're fine if you get approval for it. But if you start adding it after you go to closing, that's when you can kind of get some real surprises and some reality checks that, hey, that's on you. If you want that done, you have to pay cash for it out of your pocket, not through the lending financial process.
And Megan, I'm going to testify to it, because I have, after 30 years of lending, I have horror stories of $90,000, $100,000, $200,000 overages that the builder and the homeowner were not communicating. There's not anybody essentially, wrong to blame there. I mean, I know that people might think it's the builder's job, but the homeowner needs to be aware too. So
well aware.
Super, super important to be asking and communicating all the way through your project and tracking those expenses, because like Megan said, if they fall outside of your contract, there could be, not necessarily is, but there could be issues for you if you don't have the cash available. You're really trying to get into the project with a minimum down. So
correct.
Something to be really aware of. But Megan, this is another great one I got to thinking about as we were going through the initial piece of it. And I don't know the answer where you're going to be at, but I have a suspicion.
Okay.
Because if somebody is tight, but they've got a great builder they're working with, they can come in on budget. And we expect with the Barndominium, sometimes we're seeing, equity being increased because they're appraising well, right? Like I've seen quite a few of them like that. And if you've got that extra equity, do you allow a homeowner to negotiate closing costs into the contract if the builder pays for it? So in other words, hey, I'm just making this up, but let's say I've got closing costs of $5,000. The builder builds in their contract and agrees to pay for that up front. Do you allow for that?
That is a phenomenal question. I have never met a builder that was willing to do that and cover some of the, usually there's a contingency portion in there, and that's required by most lenders. I think it was as high as 10%, right? When COVID started happening, there were supply chain issues, all that. Now it's diminished to about 5%, which is always good to have some kind of contingency.
Okay.
But if a builder wants to pad that, absolutely, that would be an option. And what would happen if they ended up not utilizing all of that? It would not be a cashback situation per se, like actually cash transaction where they would put it back in their bank. It would literally be a principal reduction. So when it goes to convert into a long-term mortgage, that would be a principal reduction. Your payment would remain the same because it's based on the financing that was already closed on before you broke ground. But that principal reduction would reduce the principal balance that you owe on that mortgage. So if you ever went to refinance, if rates got really good 2 years after you're finished building and you're living there, you would have a much lower principal balance that would need to be paid off when you did go refinance. So absolutely, it can be done. And that's amazing that you've experienced that.
Yeah. I got to thinking about it as we were going through. I'm like, oh, that could be an option for people to think of that we really haven't talked about before. So,
Sure.
Yeah. Well, Megan, hey, thank you so much again for sharing all your wisdom and knowledge.
Sure.
I am going to put your number up on the screen. If anyone is watching, number is available. If you're listening on the podcast, the number to reach Megan direct is 470-232-0711. And you can also find Megan on Facebook. She's got her own group started with lots of good information in there. Megan, anything else you want to add?
Anything else to add? I'm in 5 states currently right now. So Georgia, Texas, South Carolina, Kentucky, and Florida. Tennessee's pending. Okay. We're almost there. But if I can help anybody in any of those states, I would be more than happy to. And just start that Barndo journey. We have clients that started this year, January, February, that are on schedule. They will be moving into their Barndos this year, August or September, before the holiday season. So it could happen for you as well if we get started right now. It's really an exciting time for so many of them.
Perfect. That's awesome. All right. Thanks again, Megan. We appreciate you being with us.
This has been so fun. Thanks, Jon. Bye, everybody. Have a great day.